With tax season coming up, you might have a lot of questions as you're prepping to file, but don't fret. I have a plan. Today, I am sitting down with the extraordinarily patient man who does my taxes, Evan Jehle.
Well, Taylor, thank you for having me, and I hope to answer all the questions, but there are a lot of questions. So we'll try to get to them all and answer as many as we can and hopefully make it as clear, because dealing with taxes, it's not always black and white. There's gray, and you have to understand how to navigate the gray so that you get it correct.
It's quite enigmatic. And I'm really excited that we're going to kind of untangle some of these issues because there are a lot, like you said. So, Evan, take me through the tax preparation process.
Okay. So the first thing that, as the tax preparer, what we have to obviously gather all of the documents to give to the tax person. And if it's a new tax person, they don't know anything about your return. They don't know if you missed something. So the first thing that I always do with a new client is I look at last year's return, because that gives me the baseline. Most people, not everybody and not all the time, but most of the time, for most people, the return you had last year is going to have the same stuff as this year. Maybe there's a new account you opened, but for the most part, looking at last year gives you a very good idea as to what you should be looking for this year. So once you do that and okay, I need my W-2, I got a 1099 for interest, I have mortgage interest, so I need my 1098 and all those lovely forms that you never really knew what they meant, but now you do. If you're a homeowner, all of a sudden, hey, 1098 means a whole new thing. You're gathering this information and then you're giving it to the tax preparer. The tax preparer, what we do then is we're going to do our little analysis from last year's return to the information you gave us, and we're going to tell you if we think you're missing anything. If we're not, great. We take the information, we put it into a tax software. People that are doing it on their own, you're using a TurboTax or an H&R Block or one of those types of softwares, and you're inputting the information. And the good thing about those for non-tax professionals is the software is actually asking you a lot of questions. And sometimes it can be really annoying because it's like, oh, another question. But the software is trying to do is make sure you don't miss anything as a deduction to try to reduce your taxes, or did you miss income or anything like that. It's really going through that process. Once that's all done and it's inputted, you're going to owe, or you're going to have a refund. And then you'll file the return, and if you owe, you'll make the payment. If you get a refund, you're going to put in your bank info and get it direct deposited, and hopefully it's that easy and you can say thanks, see you next year.
Okay, it sounds so simple when you describe it.
It does sound so simple, but going through that process, there's a lot of complications that come up.
On a very basic level, why do some people owe and some people get money back?
There's a few different reasons for that. First off, let's say you're a W-2 employee. Okay, that means you have a job. They withhold taxes. So some people in that scenario, they like the big refund. So they claim single zero, withhold at the max rate. And then when they get their, when they file their return, they get a big refund and they go, woo, I'm thrilled. Other people have a different feeling where they're like, but the IRS just held on to my money for a year. I don't want that. So they put in and say, no, I don't want to pay that much. So they might prefer to owe money or maybe just get a smaller refund. It's the tax form when you have a job and you're filling out, it's called a W-4. And it doesn't it's not like, oh, sure, check this box and you're done. It doesn't actually correlate to your tax return the way you think. So that's where a lot of people end up in trouble. They say, oh, okay, I'm filling out a W-4 and claim yourself. Yes, one. Claim your spouse. Yes, but your spouse is working. So do you claim them here? Well, you don't have to. You can leave it off and they'll take more taxes out, or you could leave it in and they'll take less taxes out, but then you may end up with it. So that's part of the issue. Is the W-4 seems like it's a really simple form, but it's not a direct correlation to the tax return. So people make mistakes with it all the time. And they end up saying, I'm married with 7 exemptions because I took the dog and the cat, and I support my mom and my cousin and my friend's brother. And so they put all these things in, but on the tax return, none of those things matter except for the kids. So, they withheld less than they should have, and you end up in a little bit of a problem. So if you don't know how to fill out the W-4, ask your tax professional for help. And then, they can help you complete that. The other reason people might owe is, let's say you're not the W-2 employee. This country has a lot of people that are sole proprietors. People own their own business, and when they're earning their money, they're not having the magic of a W-2 taking taxes out, withholdings, and paying the government tax. So instead, you have to work with your CPA much more often to make estimated payments, they're called. So you're supposed to look at your income and see what it is for the first, let's say, 3 months. And then you make the payment and say, okay, my tax for these 3 months are this. And why would somebody owe? Well, you could end up in a position where, hey, I thought I was going to make more money. And so I didn't pay as much now because I thought I was going to pay more later. I know some people that try to game it that way, and then you don't earn the money later, so you don't have it to pay in, so you end up owing. But a good reason for ending up owing is it's a concept called safe harbor. And this is a little bit advanced, but it is one of the big reasons why people owe money, and it's not a bad reason to owe money. So you have to pay by the end of the year, or by January 15th is actually the end of the 4th quarter, the lesser of 110% of last year's tax, or 90% of this year's tax. So if you're trying to manage your cash flow and you're trying to look at, okay, what do I need to pay? For a lot of our clients, they're going to look at, well, last year, let's say I made $30,000 in my sole proprietorship business. My taxable income was $30,000. So let's just say the tax on that was 10. Now I made $80,000. So now my tax is, let's say, 20. You don't have to pay that full 20 this year. You can pay 11, which is 110% of last year's tax, and then save the 9,000 and pay that in April when you file your tax return. So a lot of the business owners, when you're a W-2 employee, that's usually not going to be the case. You're going to have your withholdings, you're going to make your payments, and then that's it. But when you're a business owner, you are going to look at that to try to preserve cash flow. I always recommend, don't spend the money when you know you're going to have to use it for taxes, even if you don't pay it at that time, because you don't have to. Put it in an account, earn a little money on it. Interest rates have gone up, so you may actually earn a little something. I know in the past they were like 1/2 of 1/3 of 1/4 of 1%, but a couple of pennies is better than zero.
I'll take it.
Right. That's really, there's lots of other reasons why someone may owe money that are far too complicated to get into, but these are those are the basic reasons.
I love knowing the basic reasons, because the basic reasons to my ears sound a little bit complicated. So that's good for me. Let's stick with that. Let's continue. So we're diving in, we're untangling the knot.
Yes.
So this tax bill, what are some ways that people can reduce their tax bill?
we'll break it up again into business owners versus W-2s,
Mhm.
employees. So as an employee, it's a little bit harder,
Mhm.
just because there's a limited amount of things that you can do, especially with the new tax law that came in 2018.
Mm.
So with that new tax law, the miscellaneous itemized deductions of unreimbursed business expenses. So if you laid out money for work, like school teachers lay out tons of money for school, that they pay, they made an exemption. They get, I forget what they get, $400 or something like that. That's deductible. But then if let's say they paid $3,000, they were able to deduct the rest on a Schedule A and unreimbursed business expense.
Mhm.
And now athletes, another great example, athletes pay agents, they pay managers, they pay lawyers on their W-2 income. And they used to be able to deduct that against, on Schedule A, against their W-2 income. That whole section of the tax code is now zero. It's gone. So it's a little bit difficult. So where do the W-2s, the employees, get to deduct things on their return? One big area, charitable contributions. If you're charitable, you get to deduct it. Okay. Mortgage interest, real estate taxes, things like that. Now that, again, the tax code in 2018 changed. So you're limited to your tax deduction to $10,000. So that means your state income tax and your property tax, add them all together, and you only get $10,000. So depending where you live, you might not really get as much bang for your buck on the tax stuff, but mortgage interest is deductible. And even though I don't recommend paying high interest rates, at least you know that you're getting some type of deduction for it. What's changed, though, again, going back to that tax law, is you had the standard deduction, which I know we're going to get into, standard versus itemized. But it's important here. If you end up in a position where you get the standard deduction, you're not getting a deduction for any of those things. And the standard deduction, back when it started, I think in 2018, I think it started at 12,000 and 24,000. And then it's gone up for inflation purposes. But if you're married, filing jointly and getting a $24,000 standard deduction and you give $1,000 to charity, yes, there's a charity exemption where you get a little bit. But if you give 20,000 to charity, you're losing most of that. You're not getting it because you're getting $24,000 as your standard deduction. You don't get both, you get one or the other. And if the standard deduction is, again, we're using $24,000. If it's $24,000 and your mortgage interest is $3,000, I'd rather have the 24 and not deduct my mortgage interest. So that's actually what's happened a lot, is a lot of people that are employees of companies that have W-2s, when they're filing their returns, they're getting the standard deduction and they're not even looking at itemized. They're not looking at ways to save on their return because the government, by giving them this big standard deduction, actually gave it to them already.
Okay.
That's something, but there is a limit where for charity, you can give a certain amount of money to charity and still get it. Even if you get the standard deduction, you still get the deduction for charity. So for W-2s, it's actually kind of hard to save money. You can do an IRA, put money away for retirement. You can do a 401k at work, and now you're putting money away. Those are typically the ways W-2s would save on their taxes, but you're really doing it not just to save on the taxes. You should really be thinking about doing it because you want to save for retirement. Some people will do with a 401k, they'll do the Roth 401k or a Roth IRA, which means, no, I don't want the tax deduction. I'm going to pay the taxes now, and then it grows tax-free. And when I take it out, there's no tax, because I think that, and you would do that if you thought tax rates were going up.
Right. So if you changed tax brackets, if you earned more money later in life.
Correct.
Got
Yes.
it.
And the brackets definitely play a big role. Like I said, when we started the process, going through the tax preparation, it's a really simple process, but look at all the layers that you have to think about in order to actually get the return done and maximize your savings.
It sounds like you can be really strategic about how you go about this.
You can. Now, if you're a business owner, you can be more strategic, because there are things you can do as a business owner, because you have deductions, you have expenses. When you earn that $100, you don't get to just put that money in your pocket. Usually there are expenses. Maybe you have payroll. That's a deduction. Hey, I want to save money on taxes and my team did really well. Give them a bonus. They will feel really happy and they will love you and think it's great. And the government is essentially paying part of that bonus because you just saved money on your taxes, because that money didn't go to you, it went to them. By the way, the government doesn't care, because they're just going to get the tax from them when they file their return. The government will always get its money from someone. It just depends where they're going to get it from. But they can also do things like, I'm renting an office. Okay, now you have office rent. Let's say you make improvements to the office. We're going to do a renovation. There's bonus depreciation right now that says, instead of having that as an asset, it's a deduction. You get to deduct the whole thing right now. Things like that business owners have a bigger advantage, because they have business expenses that relate to earning their income that they can put things against.
So I want to be clear, I understand the difference between a tax credit and a tax deduction.
Okay. So a tax deduction is, and I know they always said, don't use the same word when you're explaining it. So I don't want to say it's a deduction of income, because that's, but basically it's an expense that you paid money, or it's an allowance that like the standard deduction, where they're giving you a certain expense threshold to reduce against your income. So I made $100 from selling my baseball card, but I had to give Taylor $25 of that money. That's a deduction, because my taxable income is only $75. That's how a deduction works.
I see.
A tax credit is completely different. That is a dollar for dollar tax reduction of the tax. So again, in that scenario, if I had $100 and I give you 25, I'm not saving $25 of tax. I'm saving $25 of taxable income. So the tax is calculated on $75. If I had a $25 tax credit, now I would pay tax on $100, but whatever the tax is would be reduced by $25. So a tax credit is far more advantageous, because it's a direct dollar reduction of the tax that you're paying. And most of the time you're going to get a tax credit where let's say you live in New York and you work in New Jersey, or you live in New Jersey and you work in Pennsylvania, or something like that. You work in another state than the one you live in. And that's happening a lot since COVID. People are living anywhere that, all over the country. But let's say you're working for a California firm, and you live in Pennsylvania. We said Pennsylvania. I live in Pennsylvania and I work for a California firm. The California firm might say, you know what, you're earning your income in California, even though you're not here. Because technically the firm is in California. They don't have any ties to Pennsylvania. So the fact that you are in Pennsylvania doesn't matter. You're a California employee.
Mhm.
So you would pay tax in California on whatever income you're earning there, but Pennsylvania comes knocking. Hey, you're a Pennsylvania resident. Give me my money. They want their tax too.
Uh-huh.
Yes, Pennsylvania, I will pay you your tax, but
Mhm.
I get a tax credit. So if I owe you $50, but I paid California $40, I only owe you 10 because you
Okay.
don't want to pay double tax.
Right. Okay.
Yes. Now that's a very simple, again, I'm trying to simplify a lot of what we're talking about. There's a lot of complications with state tax credits and things like that. And the state tax is higher, then you don't get it all. But as simple as I can explain it, that's a tax credit.
I think it's
Yes.
important to get the big picture. Absolutely. Okay, so I'm beginning to understand the difference between tax credit, tax deduction, itemized versus standard. Let's talk about active traders now. So
Okay.
what should active traders be aware of when they are thinking about their tax bill?
So the biggest thing when you're trading stocks, and you're making money that way, is right now there is a difference between ordinary income, your W-2, your business income, and your investment income. There's a tax percentage that you're paying that's much less than most people. So than your ordinary income. So the capital gains tax is what it's called. I'm sure everybody's heard it, but maybe you didn't know what it was. So the capital gains tax is a tax that's a much lower tax rate than what you would pay on your W-2. So if I make $500,000, my W-2 income, I'm going to pay 37% tax. But I made $10,000 in the stock market, I'm paying 20% tax on that income because that's the capital gains tax. And for a certain threshold of income, it's 15%. And for a certain other, as you get lower down your tax bracket, it's actually 0. Look at your tax bracket and understand where you would fall. But that's only for long-term capital gains. What does that mean? You have to hold the stock for 1 year and 1 day. If you hold the stock for 1 year and 1 day, you get capital gains treatment. If you're a stock seller, I buy it on Tuesday, I sell it on Friday. I buy it on Monday, I sell it on Wednesday. Then it's ordinary income. It's all taxed at the same rate, and it doesn't matter. So again, something that investment people want to understand, people that while they're trading, is there is a benefit to buying a stock and holding it for at least 1 year and 1 day, so that if you hold it, you can take advantage of a lower tax rate, which, again, the tax law changes, as we've seen, it changes quite a bit. So who knows how long that's going to be there. It wasn't there in the beginning. It's something that came in, then it could be gone, with every election, who knows what'll happen. But right now it's there and you can take advantage of it.
Okay, so it sounds like we have to ride that wave as long as we can.
As long as you can. And I don't think they'll, like in the last tax update, they didn't get rid of it, but it was 15%. And they increased it. They made it like a little rate table where it's 0% up to this amount and it's 15% up to this amount. And then if you make more than this, it's 20%, and that's that. But that was 15% was the maximum rate, and they increased the maximum rate to 20. So I don't see them ever getting rid of it, but I could see it going up again.
Okay, something to watch. Be aware of.
Right.
These laws change.
Right. There's also, on top of that, there's the Obamacare tax. That's in addition, which is 3.8%. So you're not really just paying again, I'm going to use the top rate, 20%. you're not just paying the 20%. In addition to that, you're paying the 3.8% as well, because that's how they want, that's one of the taxes that they put in place to fund Obamacare. So in reality, if you're trading stocks on long term and you're lucky enough to be in the income tax bracket where you're paying 20%, you're really going to pay 23.8% tax. But that's better than paying 37 or 35 or 32, depending on where you are. So that's how you need to look at it.
How do I know what tax bracket I'm in?
Yeah, it's
well, you know, because you do my taxes, but how does
yes.
the average individual know what bracket they're in?
And it could change from year to year. You know, you could have a big income hit one year. Maybe you got a nice bonus at work, and you know, there was a big sale at work and something happened, and you know, you got a big hit, and that pushes you into the next income level. And then, oh, well, the next year was a regular year, so now you're down here again. So your rate can change based on that. How do you know? I would go online and search for the 2020, depending on what year you're looking for, because they go up every year for inflation purposes. I would look at the 2023 income tax table, and it'll show you filing jointly, filing single. Are you head of household? You have to know what your filing status is, because that shifts the rates, the brackets. So as an example, again, I'll try to very oversimplify it. Let's say you make between $75,000 and $100,000, you might be at 20%. But if you're single, but if you're married, filing joint, that same tax bracket of 20% is double that. It's 150 to 200, because what the 2018 law did is it actually got rid of what they called the marriage penalty, where it wasn't dollar for dollar. Now, if you're single, you get X. If you're married, you get X times 2. So you're getting the advantage of having 2 people. So if you have one spouse that doesn't work, you're actually paying much less tax on your income than you would if you were single and not having a spouse. You'd actually pay more in taxes. So, you know, an interesting little tidbit for all those spouses that are not, and I shouldn't say work. If you're a spouse that's not employed, because spouses work even if they're not employed. You know, they're working at home, you know, stay at home moms, stay at home dads. That's a big job. So I don't want to say they're not working. They're definitely working. But if they're not employed, you get the advantage of that tax bracket. You know, you could save $5, $10, $20, $25,000 on your income from that. Yeah. So that's that was something where it was one of the changes. Depending on who you were, if you were single and you were getting the advantage, well, now you're not. So, you know, now you've kind of lost that. But if you were never married, you didn't really feel it. You know, you don't feel that because you don't know. You were always in this bracket and that's it. But the married people, where, you know, it should have been, hey, if he gets $10,000, why don't I get $10,000? Now you're married, you only get 15. Nope, now you get 20. Great. So it's much fairer.
Yeah.
And I think that's really what the code was trying to do. That tax law change was they got rid of some things like state tax deductions that, you know, a lot of the people affected by that were the wealthy, and they weren't trying to necessarily help the wealthy on that side. But there are a lot of regular Americans that, you know, they got hit by it. You know, we lost those deductions, and we're not making anywhere near what these people are making. So these little other areas were ways they tried to help, making the standard deduction, increasing that, giving you these benefits, adjusting for the marriage penalty. It helped the non-wealthy, you know, the non-uber rich, get kind of offset some of the losses that they took in the tax code.
Gotcha. Okay. This is starting to make sense. Thank you,
At
Evan.
least that's my idealistic way of looking at it, where I try to see the best in what was done. I don't know if that's really why they did what they did, but that's how I look at it.
Okay. I think that's a pretty fair interpretation from what I'm hearing. So let's say I have a side hustle. I sell things on eBay or Etsy. What do I need to be aware of when I'm doing my taxes?
So what you want to be aware of is that that is a business. And depending on how much you earn, you don't want to all of a sudden earn several $1,000s from this side hustle and think, oh, good, we don't have to tell anybody. No. Now Venmo and Zelle and all these companies that used to not report 1099, no, now they do. They report to the government all the money that you got. So there's no more kind of saying, well, that was not income. It was, it's me with a hobby. Okay, great. So if you make money on a hobby, you got to pay tax. If you lose money on a hobby, you don't get that benefit. That's one of the things where if it's really just a hobby, but you have a profitable hobby, it's really a business, then you have to report that. But again, you get the deductions. Let's go back to those expenses. You get to think about, oh, I'm going to deduct things. Now, what can you deduct? I get asked this all the time. There was one guy who I remember specifically said, oh, I get to deduct my clothes because I have to go to the office. And in order for me to go to the office, I have to get dressed. Yes, this is a real conversation. And because I have to get dressed, I need to buy clothes, work clothes. And it's like, well, wait, do you work for do you need to wear a uniform? Are you working for a security firm where they make you buy your own uniforms? No, I'm a lawyer. I'm an accountant, and I go to the office in a shirt and pants. And, I had to wait. Stop. No, not deductible. Sorry. You need clothes to go out and food shopping. That's not a business expense. You really want to, you don't want to be silly and just slam expenses through, because then you're going to get audited, you're going to lose, and then you're going to be on their radar forever. You want to just look at, is this really related to my business? I have income. So you're looking at it as a side hustle. Okay. I make $3,000. I make $5,000. I make $15,000, whatever it is. Well, do I have any expenses to earn that money? Yes, I have computer software because I had to buy QuickBooks or Peachtree, or I don't know, choose the accounting general ledger of your choice. And I had to pay for that. So I had to put that in there, and, I got to pay my accountant to do the tax return for my business. And so, that becomes part of the deduction. And maybe you have to pay a 1099 to someone because maybe you had someone who helped you put things together, or you had to buy fabric, or you had to buy materials to complete whatever it is that you're selling. Those materials are cost of goods. Those are expenses that you get to take against that income, because if you didn't pay that money, you wouldn't have been able to create what got sold. Those are expenses that are deductions against the income that you get to save against your taxes. So even if it's a side hustle, you want to look at, are there any expenses related to my side hustle, so that you don't pay tax on, look, I had a side hustle, I made $3,000. And, man, my accountant's telling me I got to pay tax on that. Man, I don't want to pay tax on that. Like it was a little thing, no big deal. Well, maybe you don't have to pay tax on $3,000 because you paid $1,000 to make whatever it is that you sold in that side hustle. So now your taxable income is only $2,000. So, you gotta look at it that way. just don't assume that it's cash, and I'm not gonna, no one's gonna know about it, and I'm gonna, pretend that nothing happens. Okay, if that's the way you go and you get caught, poof. No,
Yeah.
you don't want that. You don't want that. It's not worth it.
No, it's better to be truthful, straightforward. You don't want to mess with the tax people, the government.
No.
You don't want to go there.
Yep, exactly.
This is a lot of information, but I feel like I have a better understanding of how to go about this. So thank you, Evan. Any last words, tips for people as they're kind of looking at all of this information and figuring out next steps?
Well, first of all, I would say be nice to your CPAs, because not everybody is always nice to us. They want, now. And it's like, I love the people that come in on April 14th at 8 p.m. and they're like, here's my stuff, get it done. And it's like, come on, man, we got like, and they look at it like, I gave you a day.
Yeah.
Try to gather your information. Your information is done early. Your W-2s come out sometime between the middle of January and the end of January. Get the stuff to your accountants as soon as you can so that they can jump on it and get it done in a reasonable time frame. And if you need any help, don't wait. A lot of people, they'll wait until January or February even to ask, well, how should I have treated well, now it's too late. If it's the middle of the year and you have a transaction and something happened, don't be afraid. Pick up the phone and say, hey, you're my accountant. I need some guidance. What should I do here? That's our oath as accountants. We're here to help. And we're here to guide you on the right things to do, but also help you minimize taxes. And that's I guess that's where I'm going to close. There's a big difference between minimizing taxes and evading taxes. Evading taxes is very, very bad. You go to jail for that. That is, I'm lying, cheating, stealing, making stuff up on my return. I say I had expenses when I really didn't, and I just slam stuff on there to make a fake return so that I don't pay tax. No, all those things, bad, 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 bad. If anyone tells you to do that and they say they're your friend, they're not. Turn around and run. Minimizing taxes, you are not required to pay more than the minimum amount required on the return. So find all the right deductions, work with your accountant to make sure you're minimizing your taxes and paying the correct amount and not 1 penny more than you need to. There's nothing wrong with doing it that way.
I love that, Evan. Thank you so much. This has been really helpful for me personally, and I know that all of our viewers will find all of this information super valuable. So thank you so much for your time and for all that you do.
Well, thanks for having me. I appreciate it. I hope I wasn't too, zany, but, it's not an easy topic to explain.
Yeah.
So, and again, there's a lot of nuances. So I hope at least when everyone's watching the video, I hope I at least made tax not as boring as it really is.
I think you made taxes pretty fun.
All right. Well, then I did my job for the day, and I feel like I can go into the weekend feeling great.
Okay. One last question, Evan. Am I a good client?
You are a fantastic client.
Yes.
Fantastic.
Yes. Love to hear that. I love
Yes.
Yes. Okay. Well, then I'm sated. Thank you, Evan.
You got it. Thank you very much. Have a great night, everyone. Great day whenever you're watching this.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.